Bristol Myers Squibb's company, learning from the past with fast graphs. Simple observation of this long-term adjusted operating earnings fast graph shows that Bristol Myers Squibb had a minus 45% drop in earnings from 2001 to 2002. Then it had a nice 34% recovery. Then it had falling earnings by as much as 4%, 16%, and 24% 3 years in a row. And then it recovered very nicely, and the long-term growth rate using this timeline was 5.54%. However, if I eliminate those early down years, coming into the Great Recession of 2008, Bristol Myers Squibb grew at 11.96%. But as I look at this graph, I notice that the company once again did have a few down years in 2012 and 2013. Hello everybody, this is Chuck Carnevale, co-founder of Fast Graphs, the Fundamentals Analyzer software tool, aka Mr. Valuation. And what we're going to do today is take a look at the pharmaceutical giant Bristol Myers Squibb through the lens of fast graphs. And I'm going to walk you through how I use the tool to analyze companies and how I use the tool to help me make, good investment decisions, especially long-term investment decisions. This isn't a trader's tool. It's a prudent long-term investor's tool. FAST is an acronym for Fundamentals Analyzer Software Tool. So let's go back into the tool and look at Bristol Myers Squibb again. Now, what I have on this graph is adjusted operating earnings, and you can see that the earnings went from $1.38 up to $2.16 up to $2.28. Then we had those down years I referenced, and then it's had really good growth. What I really like by looking at this graph is, number one, going into the recession of 2008, this company actually grew. Not only did it grow earnings, but it also grew the dividend and then maintained it as we went through probably the worst recession we've had in years. Same for the pandemic. The company's earnings growth was actually spectacular during the COVID pandemic, which of course happened in 2019. Now, when I overlay weekly closing stock prices, I get all kinds of important perspectives that I don't get by just looking at the earnings line, and that I also wouldn't get if I just looked at the price line. Number one, this orange line represents a theoretical calculation of fair value for the company, representing a PE ratio of 15 or an earnings yield of 6 to 7%. So that would be normal. Now, by running my mouse along the price line, I can see that there was a period of time where PEs were in the 20s. I can see during the Great Recession, the PEs were in the 10, 11, 12 range. I can see, ironically, as they were recovering from some down years, the market got irrationally exuberant and the stock was trading at 20 and 30 PEs, only to, fall back again over the next several years into the single-digit PEs. And currently, you can buy this company at a blended PE of 9.41, has an earnings yield of 10.63%. My minimum threshold is 6.7, as I said, or 6.27 is where I like to always think in terms of a range. Offers a dividend yield over 3%, and it's had a really strong growth rate. Now, one of the important things that I want to know also is, why is the market been valuing it differently? So I can also apply the second valuation reference line, and that's the normal PE. Now, this line will recalculate as I draw different time frames. So if I shorten this to a 15-year graph, my growth rate slows down to 10.5%. My normal PE, 17.8. These are reference lines. I can look at that normal PE, knowing that it's a PE of, we'll call it approximately 18, and I can tell when the stock is trading at lower PEs. I can tell when the stock is trading at higher PEs. And as you can see, for the last several years, it's been trading at much lower PEs. Okay, I can shorten the time frame again, and now all of a sudden I've got a 16% growth. Now that's very unusual for a company that's $151 billion, almost $152 billion market cap, to actually see its growth rate accelerate in shorter time frames than over longer time frames. But we see that with Bristol Myers Squibb. But I'm also analyzing what I'm looking at. I just don't look at the picture and say, oh, the price now is above the orange line, it must be cheap. Because I see some things here that I want to pay attention to. This growth rate of 16.24% is predicated on some very high numbers interspersed. I got a 41% growth, a 9% growth. So it's essentially the average, if you will, or really it's from going from point A to point B of all these numbers mixed in together here. But if I look at this graph, I can see that the future numbers are expected to be much lower. So if I draw this as a 3-year graph using only the current year we're in and then the 2 forecast years, which I'll get into in greater detail, my growth drops down to 3.5%. That's going to impact greatly what I think about this company. I'm not looking at a 16% grower like I was, when I, drew the graph over a 10-year period of time. I'm really looking at only a 3% grower. Now, I'm looking at the company from a standpoint of operating earnings. I can look at it also from a standpoint of diluted earnings or GAAP earnings, and I get a red flag when I look at GAAP earnings because I see this big drop in 2020. Earnings actually went negative. Now, GAAP earnings contain a lot of accounting convention, non-recurring charges, accelerated depreciations. It could be anything from an accounting point of view. But I have a very, very different perspective. Now, I don't like this because this is not necessarily cash flow related because there's too much accounting convention in there. A lot of investors will talk about wanting to use GAAP numbers. I think it's important to look at GAAP numbers because GAAP numbers tell me a lot about what's been going on with the company. Something major happened in 2020, and we'll address that later. I can see that clearly here. I don't know yet what it is, but I do know that their GAAP earnings went to negative $4 during that period of time, probably from some massive charge-off. Now, I've also got all-important cash flow numbers because this is a dividend-paying stock. So I want to look at operating cash flows covering the dividend. Now, the company has a good record, but somewhat spotty. There have been several periods of time over the past 20 years where their cash flow didn't cover their dividends, which meant they had to pay their dividends or increase their dividends based on, retained earnings or, from other sources, borrowing money, etc. So that's kind of a red flag. But if I look at the last 5 or 6 years, the company's had a big change in their growth trajectory and so on. If I draw this as a 6-year graph, again, I get that 16% growth rate. I can also use my slider here and take this back and get rid of the forecasting data, which has the low numbers. And really for the last actual 5 or 6 operating years, I've got just a 1 quarter of estimate here. The company's actually grown at almost 30% a year. So automatically I can see that the growth rate has been staggeringly different. If I put the price on the graph, I get the very similar picture to what I got when I looked at operating earnings. I got periods of undervaluation, periods of overvaluation, and currently the stock looks tremendously undervalued. I will go through all of the metrics, free cash flow, and look at the same thing. I'm looking at free cash flow covering the dividend. I'm not really as concerned with the price as I am the dividend coverage. Again, I consider this a little spotty when it comes to this company. But on the other hand, it is an A+ rated company and has about 50% debt. And I'll talk more about debt here a little bit later. Other things I can look at is another form of cash flow, I like to call it, which is Ebitda. It was either Charlie Munger or Warren Buffett said, it's earnings before all the bad stuff, but it's actually earnings before interest, taxes, depreciation, and amortization. So it's very similar to the operating earnings that we showed before. Now, I like Ebitda, even though it doesn't contain all the bad stuff. It does kind of show how the operations of the business, I call it a soft form of cash flow. So I like to look at Ebitda. And I like to look at how the stock is priced relative to Ebitda. And with Ebitda, we only produce a normal price to Ebitda. I want you to know there's no blue line on this graph. It's only the orange line. But you got to be careful because if you change time frames, this number changes. So you want to be looking at the normal price to Ebitda from the long time. But again, that number simply gives you a reference, something to think about and analyze. I know this orange line is 12.35 times Ebitda, and so I know when the stock is trading at valuations below that. I know when it's trading at valuations above that, and so on, et cetera. I like to use the long-term graph when I'm looking at Ebitda is the simple, point. EBIT is very similar to the Ebitda graph, but, I do see this big, strong surge. I do see this drop in 2020. This is earnings before interest and taxes. So it's not including, depreciation, amortization, etc., as we do with Ebitda. And then finally, I think this is one of the more important metrics. I like to look at price to sales and look at the company from a standpoint of, sales and revenue growth. So here I see that we've had growth of about 4%, but I also want you to take advantage of these time frames. I change the time frame, I get a different growth rate. Fast Graphs is measuring the growth over the time frame you're looking at. So if using more current time frames, I've got almost 7% growth, but I still have, a couple of negative years in here. So I drop that by just simply looking at a couple more years, and all of a sudden I've got 9% growth going over the last couple of years. I take out the estimate data and add 2 more years back to that, I've got almost 11% growth. I'm looking at this recent growth to me is more important than historical growth. And even by doing that, I get lower valuations than historical norms. I got one of the fastest periods of growth here, and I've got a real low valuation. So that is a plus. So all in all, when I look at this stock so far, by looking at these valuation measurements, I consider the stock appears to be very undervalued at a blended PE of 9.4. Is it worth these higher numbers? Well, let's figure it out. Let's do that by going into, and by the way, I want to make a point before I leave this. I also use this performance calculation to teach me about valuation. When I look at this chart here, the stock is overvalued and it's gone to undervalued with a 5% growth rate. If I run performance during this period of time, I only get a 1.5% capital appreciation rate. I add in the dividends of $5,688, I only get a 3.26% rate of return. My problem here is that I've had moderate growth, 5.5%, but I've way overpaid for that growth back here in the beginning. And right now, the market is not willing to capitalize. This stock is undervalued. I think it's trading for less than its true worth value right now. So, that gives me a problem. Now, I take a couple of years off of this and I still have a high valuation. I take a couple of more years off of this. Now I'm looking at the stock trading at really a discount. If the 15 PE, which this orange line represents, is fair value, then if I can buy it at a 13 or a 12.8 PE, then I'm buying it at a discount here. But it's also only at a 9, so I'm going from a 12.8 PE to a 9.4 PE here. So when I run my performance here, I'm going to get closer to the performance of the company, an 8.2% rate of return, which I do want to point out is less than the 10.28% growth because of the discount in the PE ratio. But I'm seeing that in pictures, and the numbers then obviously corroborate that. But the company does have a stellar dividend record, modest dividend growth, only 2.5%, 3.5%, something in that neighborhood. But it did allow it to pay a lot more dividend income than I would have gotten in the average market. So I'm looking at that as a very strong positive as well. Okay, so as I'm measuring performance, I could go the other way and I could look at performance here when the stock was way overvalued, with a PE of 32 back here in December of 15, and I can tell you I'm going to get a lot less than 16.24%. I run the performance here, and I've got 2.22% annualized capital appreciation, or growth, if you will, and I only got a 4.5% total return, and I did that by investing in a company that was growing at roughly 14, 15, 16%. Valuation matters, and it matters a lot. But this is how I look at those things. But I've learned now a great deal about the past by running it through all these machinations and all these different earnings and cash flow metrics. But now the question is, I can only invest in the future. So what does the future look like? So I turn to the forecasting calculators. Now, forecasting calculators are very useful for several reasons. Number one is they show you what the analysts have been doing for the last 6 months. And in this case, 6 months ago, they were expecting 745 on Bristol Myers. They raised it then to 748 3 months ago. And then it was raised again to 751, which is the current estimate by 20 analysts that follow the company. So, the estimates for 2021, came in at $1.21. This is an actual now, remember, and that was pretty good. Now, when I look at the current year, which we're about 1 quarter away from, this does have a fiscal year. Analysts were forming 777, then it fell to 756, then it fell to 750, and now we're at 749. So this trend is not really critically disturbing, but it is telling me that the analysts are getting less positive about the future of Bristol Myers earnings for this calendar year, and that's a question that I might want to have answered later. And then if I look at 2023, I get a very similar picture. I get 820 going to 799, and then if I look at 2024, I get 833 that went from 864. So analysts have been weakening their position. Now, at this point, I want to immediately go to the Analyst Scorecard and look. Now, Bristol Myers happens to have an impeccable scorecard. When analysts were making their forecast 1 year in advance, they've had a perfect record. It beat it 31% of the time and hit the estimate 69% of the time within a 10% margin of error. It's important that you recognize that. On the 2-year forecast, also a perfect record where they, had a 20% margin of error and they beat it 23% of the time, hit it, and they had 0% miss. So what this is telling me is, using the earnings metric, that the analysts have been very accurate getting the estimates right. Now I can also look at things like sales and look at how it's also had a very good sales estimate, because I can look at the company from sales. I can look at all these metrics. I'm just trying to be brief here in the video, and then I can see what sales look like. Now I've got the estimate tab and the normal multiple tab are based on the same estimates and the same analysts, okay? So if I look at the earnings multiple, I'm still looking at the same, in this case, sales numbers. If I'm looking at earnings, I'm looking at the same earnings numbers, 749 to 799, and that's the same numbers that I have here, okay? But now I'm using the normal multiple. In the case of Bristol Myers, we default to the last 5 years, but I can look at normal multiples, how the market has been valuing. That's what the normal multiple is, how the market's been valuing it. And I can see what the trend looks like. And one thing that's disturbing from a point of view is that the market more recently has been putting lower multiples. I went to a 1-year multiple, it's only 8.97. Current blended P is 9.41. Now I can point to different spots when I apply. I can do as many what-if scenarios as I want. I can run it at an 11 multiple, and then calculate what my rate of returns are. So, the point is, I think you should always run the numbers out to their logical conclusion. And this is a forecasting calculator. I want to emphasize that. It allows you to run calculations on the fly. Now, so you can say, well, what if it does go to a 15 plus PE? Then if I can point to the 15 spot here over on the far right, this would be what my rate of return would be. If it only trades at 11 PE, my rate of return, out here to the end of 2024 would be 15.9% annualized, including dividend income. Now, another thing I can do when I'm here is I can go to external links. This is a research tool that's designed to help you research stocks faster and more efficiently. I can go into Yahoo, for example, and look at estimates in Yahoo, and I get a different number of analysts, and I get 751 and 801. If I go back to the fast graph, I had 749, which is 2 cents lower, and 799, which is 2 cents lower. But I also had 2 analysts not included in the survey. Now, this could be entirely different. I shouldn't say that, but I'm saying there's only 17 analysts here. On the Yahoo numbers, I'm looking at 16, 18, and 19 analysts. So they give me the quarter data and then the annual data on Yahoo. The point is, I can run other estimates. The long-term growth rate is also a consensus of how the company is going to grow long-term. This is really a trend line number. Once again, if I go to external links and go into Yahoo estimates, I can go down to the bottom here, and I get a number on Bristol Myers of 4.65% over the next 5 years. Not exactly the same estimate, but close. So I've got 4.6 and 5.29. That's a pretty tight range. They're expecting this company to grow somewhere between 4 and 6% over the long term, different sets of analysts. So I can use those numbers. Now I could then go into the custom calculator and I could put in, let's say, 4.5% growth if I wanted to, by just typing it in there, hitting draw, and notice that this number changed and I've got 4.5% growth now, and I can run. I can also put in my own earnings and my own dividends if I have that information available. And then finally, the last estimate that I want to point out that you can use the company's historical growth rate. So the 5-year compound growth rate was 21. This does not include estimate data. I can look at this for all the different growth rates of the company by scrolling here and come up with a number. Now, maybe a 9% number would be a conservative number relative to historical norms. I could put that in and say, what if it did that? This is what my rate of return would be. If I wanted to be more aggressive and was more aggressive, I could put the 10.9. But the question is, 5 to 6 is what the analysts are expecting. I can put that in there and probably get a much more realistic number. So I've got the ability to run the numbers through to their logical conclusion. And I can do that with all of these different metrics. I want to make that clear. And I get different numbers with the different metrics, all right? And, that's real important when you're looking at it here, but the numbers are going to be similar, if not, identical in some cases. And I can also check my analyst scorecard with each of these metrics and see, operating cash flow record has not been as good. Now, I want to take a moment here to look at that, because if I go back into the historical graph and then run this company, using that operating cash flow number or diluted earnings number, I get this 2020 number that's real low. Okay, remember that, because that's going to become important here in a few moments. So I've now looked at the company through a lot of different iterations here to try to give me a perspective. And generally, I'm walking away from the analysis at this point saying the company looks very inexpensive right here. It looks like the fundamentals are better. Even though the growth rate is slowing down a lot, that risk is already mitigated in the fact that the company has a 9.4 blended PE ratio, which is, well below the 15 maximum that I'd like to pay to buy a company. Ben Graham said never pay more than 15 times earnings. And that's partially one of the reasons why you'll see a lot of fast graphs drawing when they use the formula Graham-Dodd peak was growth rate. They'll be drawing a 15 PE, because that's a pretty traditional and pretty prudent and pretty reasonable number. Now let's move on. Let's go deeper into it now using fast graphs. I can then go to the financials. Okay, and we've always had fund graphs where you could look at the company in per share, in millions, and then also ratios, and you get these profitability ratios, and you can look at the company from a lot of different ways. In the in millions graph, you can look at it from gross numbers. In the per share graph, you can look at per share. Now, why is that important? That's important, as I'll show you here in a moment, because if I look at diluted or basic earnings, I can see differences. So gross numbers are going to be divided by a different number of shares outstanding, and you got to keep that in mind as you're analyzing the growth numbers, okay? Now, to try to help with all that, we're developing what we call the fiscal fitness section, okay? And there are some important representations that I'm looking for here. Now, I've never seen a perfect company. I'm looking for companies that are strong in most of these categories, and maybe even all these categories, but not perfect. Okay, so the first fiscal fitness score that I'm looking at is free cash flow to the dividend. Okay, that's very important to me. And what I'm seeing here is that Bristol Myers Squibb, and I put more credence in the closer years, in the 5 and 10 year data, than I do the long-term data, because it's too far back in history. The company's totally different, and that'll become evident here in a moment. But if I'm looking at the last 5 years, I can see that the company's free cash flow has covered their dividend each and every year there. So that's a nice plus. By the way, I can also looking at that data over the last 20 quarters when I'm looking at the company, and that gives me, the ability to get a little more granular, although I like to look at the yearly numbers personally. I can do the same thing with operating cash flow, but what I'm looking for here is I want to see what operating cash flow growth is. The compounded growth of operating cash over, these last years here has been over 33.6%. That's very, very strong. And I'm looking at, 6 years of growth here. I can, run different time frames where I had a lull in the growth and my growth rate gets slower. But more recently, there's been an acceleration, and I like that. I'm going to look at share buybacks, or really what I'm looking at here are shares outstanding. And I do want you to notice in 2020, where we had that real bad year, if you remember, on earnings, the company did issue from 1.7 billion shares to 2.3 billion. So they did issue a lot of shares there. Now they've reduced that share count ever so slightly in 2021. But again, I can run through this stuff at quarterly data as well and get a little more granular. But again, I'm trying to be, concise with this video. It's already gone almost 26 minutes. I can go through operating cash flow to net income. There's where I have this big net income drop, and I want you to keep that in mind. That begs a question: why was their net income so bad in 2020? I can go in and look at sales revenue. I like the trend in sales growth. I can look at net income growth, and once again, I see that really bad year in 2020. I can look at debt to equity. All of a sudden, the debt has really ballooned up on the company. That becomes something to know. I can look at margins, starting out with gross margin. This black line represents industry norms. And generally, this company's been beating industry norms until the last couple of years. Again, there's that pesky 2019 and 2020 again. And the same is true as operating margin. And then the same is true with net margin, where we had this big loss. Okay, that's something I want to know more about. I can look at asset turnover. I'm going to go quickly now. Return on assets, return on equity, and return on capital. And I'm going to look at all these things and try to determine, if the company's all of a sudden fallen out of bed here, I want to know why. And that's something to find out why. I'm going to turn to the financial statement. Okay, now when I go in the financial statement, I want you to notice this handy little tool here. You can highlight the rows that you're looking at, both vertically and horizontally, and therefore focus on the number. And 2020 was our pesky number. Okay, so I can look at things here, like notice that cost of goods sold ratcheted up, almost quadrupled from 2017 or 2016. Okay, cost of goods sold were very, very high. Depreciation and amortization was just enormous compared to historical norms. So something was going on here. Well, I'm going to tell you what it was. You can check it out yourself. But it was the Celgene acquisition or merger. And so that created this difference in things. But, research and development costs went up. And now I can look at all this data. I can also expand these items and see, a little more granularity as far as what the financial statements are. And I'll do that. And again, I'm starting to skip along here. Now, I can also then look at the balance sheet and see what's been going on with the balance sheet over time, especially with, looking at things like their cash, looking at things like inventories, what's been going on with inventories. I can collapse that or expand it. I can, look for plant and equipment. I can look at really deeply into the financial, and then the cash flow statement. I can look at the cash flow statement, and I can look for items that, we had this, net income negative in 2020, and that's again. But there are a lot of reasons we can look at what, the expenses that the company created by going through the financial statements. And that's really for a different video. But the point I wanted to make is this is how I use the FastGraph financial tool to analyze the company. My current posture on this company is it's a very high quality company. A lot of the negativity is a function of the big acquisition of Celgene, but the big acquisition of Celgene has also done a lot for their top line, as well as I think their bottom line going forward. They are going to have to digest things from here. Once I've done that, I go into external links. And we have some preset ones like Morningstar, which I am a subscriber to. I can go into Morningstar. They're currently giving Bristol Myers Squibb 3 stars. They feel like the fair value is $66 a share. The last close is $70. That's their opinion. The 1-star price is $89. The 5-star price is $46. The 5-star price is my general definition of, fair value rather than Morningstar's, but I can read all this research on Morningstar if I want. I can go into Seeking Alpha, and I can look at recent articles on Bristol Myers Squibb, and of course see what the stock is doing today. I can read these different articles. As a subscriber to Dividend Kings, I can go into the Dividend Kings, and I can go ahead and search for Bristol Myers. In other words, I can start doing a lot of research, but the very first thing I do when I'm looking at a company is before I go into these external researches, I like to go directly into the company's website, and I like to go directly into investor services, and I like to look at any events that they've had and go through the presentations and look and see, what I can learn about the company, what I can learn about, their product portfolio, what they've got in phase 1, 2, and 3. I can look at their numbers. I can look at reconciliations of their numbers. And so I can spend a lot of time learning about the company. But in terms of analyzing Bristol Myers Squibb, my answer would be I think the stock is undervalued. It offers a extraordinary dividend income. I can look at things like, normal dividend yields, historically where they've been as another valuation reference I can apply. So there's a lot of pieces to FastGraphs that you can use, and I've gone through it very quickly, even though this has been a half-hour video. You can see that, my bottom line is I think the stock is very inexpensive, but there are things that you need to be aware of. Anyway, this has been Chuck Carnevale saying thanks for watching. Hope you enjoyed this video. If you did enjoy this video, give me a like, ring the bell, subscribe to the channel. And if you're not already a subscriber, for goodness sake, take a look at FastGraphs. What a wonderful tool to help you analyze stocks faster and deeper. Keep one thing in mind. I did a 30-minute video here, and yet know probably as much about Bristol Myers Squibb as, people that have spent hundreds of hours trying to pour through data that isn't organized as well as FastGraphs has it. Thanks for watching.